Hello guys, this is a video of a student project led by Financial Statement Analyst Consultancy Firm for Dr. Brian Kaulu's Financial Statement Analysis course at the University of Zambia. The members of the F.S.A. Financial Consultancy Firm are Analyst Nakalonge, Peggy Mwanza, Zamwe Ruth Banda, Tiwange Zimba, and Kapelwa Mwilwa. Diving straight into the background, Financial Madison Services PLC Zambia is a publicly listed, diversified financial service group operating as a non-banking financial institution, NBFI. It is a key player in Zambia's financial sector, known for providing accessible credit and innovative financial solutions to individuals, small and medium-sized enterprises, and corporates. Its shares are listed or traded on the Lusaka Securities Exchange, LUSE, under the ticker symbol MFS. The group operates through a series of specialized subsidiaries, each focusing on a different segment of the market. These subsidiaries include the following: Madison Financial Company Limited, Madison General Insurance Zambia, Madison Life Assurance Zambia, to mention a few. Their mission is typically centered on empowering Zambians and their businesses through flexible and customer-centric financial products that are often more accessible than traditional banking offerings. This assignment will focus on Madison Financial Services. Thank you.
My name is Analyst Nakalonge, and I'm going to talk about profitability ratios, starting with the return on equity. So in this video, we calculated return on equity using the due-point formula. So this is how it was calculated. Return on equity is equal to the net profit margin times assets turnover times the equity multiplier. So in the year 2020, we found the return on equity to be negative 311.9%. Then in the year 2021, the return on equity was found to be negative 49.82%. In the year 2022, the return on equity was found to be negative 0.34%. Negative equity and fluctuating profits show financial distress and dependency on debt financing. We come to net profit margins. Profit margin is calculated as follows: net profits divided by sales revenue. So in the year 2020, the net profit margin was 105.66%. The year 2021, the net profit margin was 49%. And the year 2022, the net profit margin was negative 0.03%. The company briefly achieved profitability in 2021, but slipped back into a tiny loss in 2022. The trend suggests inconsistent earnings. We move to gross profit margin. So we could not calculate the gross profit margin for the year 2021 and 2022 because the gross profit was not stated in the financial statements. Therefore, we only calculated for the year 2020, of which we found it was 114.72%. We come to the operating margin, which is calculated as follows: operating profit divided by sales revenue times 100. So in the year 2020, the operating margin was negative 71.3%. 2021, we found it to be at 5.38%, and in 2022, we found it to be 2.27%. The business improved in 2021 but struggled to maintain operating efficiency in 2022. Declining margins indicate rising cost or weaker sales. The last one is return on assets. So it is calculated as follows: net profit divided by total assets. In 2020, we had a negative 11%. 2021, we had 3.22%, and 2022, we had negative 0.0156%. So I'll say that the company's assets are not generating consistent returns, suggesting either overinvestment in assets or poor revenue utilization.
Guys, my name is Peggy Mwanza, and I'll pick it up from where my colleague ended. So we'll first start from liquidity and solvency analysis. So we'll first start calculating current ratio. So current ratio is cash equivalents plus loans and advances to customer plus other assets. So in 2020, our current ratio was 0.98. In 2021, it was 0.61, and in 2022, it was 0.64. A current ratio below 1 suggests potentially liquidity issues as current liabilities exceeds current assets, and the company may face challenges meeting its short-term obligation. We'll further look at quick ratio. So quick ratio is equal to cash plus marketable securities plus receivables divided by current liabilities. So in 2020 it was 0.96, in 2021 it was 0.1, and in 2022 it was 0.17. In 2020 the company had almost enough liquid assets to cover its current liabilities, and even if it improved in 2021 it still raises issues on its liquidity as it's still low. We'll further go at looking at the cash ratio. So cash ratio is cash plus marketable securities divided by current liabilities. So in 2020 it was 0.96, in 2021 it was 0.1, and in 2022 it was 0.17. So the company had enough cash to cover about 96% of its current liabilities, but the cash ratio dropped to by 0.1 and 0.17, indicating that the company might have challenges to meet its short-term obligations. We'll further look at the debt to equity ratio, whereby debt to equity ratio is the total long-term debt divided by total equity. So in 2020 it was 27.36, in 2021 it was negative 16.56, in 2022 it was negative 19.06. So negative debt to equity ratio signals significant financial distress and potential insolvency risk. We further go to looking at the interest coverage ratio. So interest coverage ratio is equals to income before interest and taxes divided by debt interest charges. So in 2020 it was 0.53, 2021 it was 8.85, and in 2022 it was 0.2. Then we'll further look at the efficiency and activity ratios. So asset turnover is annual sales divided by average total net assets. So in 2020 it was 0.31, 2021 it was 0.64, and 2022 it was 0.64. So the company significantly increases from 0.31 to 0.64, which shows they improved their efficiency in using assets to generate sales, and it maintains 0.64 as its level of efficiency over the next year. So we'll further look at the common size analysis for 2020 for the income statement. So item number 1 is interest income, where the percentage was 95.6, interest expenses 65.5%, net interest income 30.3%, other operating expenses 4.4%, operating profit 34.5%, operating expenses 55.9%, impairment 0.1%, profit or loss before tax 21.5%, income tax 10.3%, loss for the year 31.8%.
My name is Kapela Mwela, and I'm going to be talking about the cash flow analysis. So in 2020 analysis was called the crisis year. So the operating cash flow was a positive amount which was generated, though there was a 35 million loss to start with. The investing cash flow was a negative, and this was due to defensive liquidity investment. The financing cash flow was a positive number, which was due to net borrowing to survive, and the net cash exchange came to an amount of 3,278, which was a slight improvement. The 2021 analysis, which was called the recovery year, went as followed. The operating cash flow was a positive, which was a massive recovery due to the subsidiaries performing well. The investing cash flow was a negative, which was due to a heavy investment. The financing cash flow was a negative, which was due to major debt reduction, which means they were paying back the loans that they got from the previous year. And the free cash flow calculation came to an amount of 5.7 million, which was calculated by subtracting 101 million from 106.7 million. 2022 analysis which was called the optimization year, the operating cash flow had an increment of 28%, which was an excellent growth. The investing cash flow had a negative amount of 30%, which meant more disciplined spending. And the financing cash flow was a negative of 15%, which meant there was a continued debt reduction. And the net cash change came to a positive figure of 19,507, which was the first year Madison recorded a positive number. Trend analysis. So we first look at the operating cash flow, which basically showed how much money the company had each year in operating. In 2020, there was 26.7 million, which was a survival due to their losses. And in 2021, as a group, there was 106.7 million, which was a recovery from the previous year. And in 2022, there was an increment of 28% from 106, which came to 136.9 million. And then we look at the cash flow, free cash flow evolution, which basically shows how much money the company had in excess. So in 2021, there was 5.7 million cash in excess, which was minimal but was still free cash. And in 2022, there was an increment from 5.7 to 66 million, which was excellent free cash and led to a one. And when you look at the cash position recovery, it shows how the company had an amount of 100.7 million in 2021 and had an increment of 19% in the next year, which is 2022, which went to an amount of 119.9 million. And last but not least is the common sense analysis. What is the common sense analysis? This is basically converting cash flow to percentages to understand the proportion and efficiency. So for 2021 group common size, the operating activities was 100%, which is the 106.7 million. The investing activities came to a negative 94.6%, which was a 101.0 million, which used most of the operating cash. The financing activities had a negative 51.5%, which was due to major debt reduction, and the net result was a negative 46.1%, which had a negative net flow cash. For 2022, the operating activities had 136.9 million. The investing activities had a negative 51.8%, which is much more balanced, and the financing activities had a negative 33.9%, which has a sustainable debt reduction. The net result came to a positive 14.2, which was a positive net flow analysis. Positive net cash flow rather.
Coming to the 60th part of the financial analysis, which is the earnings quality, comprises of the cash conversion ratio, accruals ratio, and quality on earnings ratio. The cash conversion ratio, which is operating cash flow over net profit after tax for 2020, was negative 0.76. The accruals ratio, which is the net income minus operating cash flows over average total assets, was negative 0.194. The quality on earnings ratio, which is cash from operations over net income, was negative 0.76. Analysis for 2021 shows the cash conversion ratio was 0.2, the accruals ratio was negative 0.6, and the quality on earnings ratio was 2.6. The analysis for 2022 was the CCR was 0.2, the accruals ratio was 0.11, and the QOE, which is the quality on earnings, was 27.7. Coming to the red flags, for the CCR, a ratio greater than 1.0 is generally excellent. The company is generating more cash than its accounting profit, but a ratio less than 1.0 is bad, as it indicates the company is reporting accounting profits that are not being realized on cash. For accruals ratio, a negative indicates that cash flows from operating is higher than net income, suggesting that the company is generating strong cash flows and may be using conservative accounting. The IFRS 10, which is the Consolidated Financial Statements, has an impact on MFIM. It's the Consolidated Madison Asset Management Company due to regulatory positions, and this resulted in a significant gain of 178.8 million from the recognitions. It had a similar control-based principle and more detailed guidelines on variable interest entities, which could lead to different treatment of entities under regulatory control. The IFRS 17, which is the insurance contract, which was effective in 2023, was leading to different profit patterns, which had an impact on major implementation challenge for 2023, significantly affects revenue recognitions and liability management for insurance subsidiaries. The impact affects impairment on loans and fair value measurements and equity. The financial statement impacts and revenue balance sheet. Revenue recognition, insurance premiums, IFRS 17, which had the current fulfillment value, versus US GAAP, which had a different approach, affects timing and amount. Interest income, largely aligned, but minor impairment timing differences could affect net income. The balance sheet presentation and IFRS was more flexible in presenting regulatory capital. We move on to the financial statement impacts of cash flows and investment decisions. Cash flow classifications, IFRS, were more flexible for insurance related cash flows. The US GAAP was more prescriptive, had more prescriptive rules, potentially leading to different classifications. It had an impact on investment decisions and comparability issues, which was the different valuation, loss recognition, timing, and capital presentation versus US peers. The risk assessment for 1.5 million kwacha investments, just to mention, was the IFRS related risks, implementation risk, regulatory complexity, measurement uncertainty, mitigation factors, regional consistency, and global standards. In conclusion, from the analysis of Madison's statements, the company is highly distressed and highly leveraged and unstable. It is unsuitable for a retirement package of 1,500,000 kwacha given the company's inconsistent profitability, liquidity, and solvency risks. Investing in this company would jeopardize retirement security, therefore should avoid investing in this company.